So if we're talking about a doctor who pays, 50% taxes between federal and state on his earned income, but the syndication gives him another $20,000 of cash flow that he's paying no taxes on, I think we can all agree that's some pretty significant tax savings.
All right, guys, welcome to another episode of The Report. Today, we got a very special guest who's actually going to be joining us for our Beers and Deals meetup tonight, rooftop here in downtown San Diego, Lida, Italy. We just came off of our yacht meetup last weekend. We got the Beers and Deals meetup tonight and looking forward to it, but really excited because we got a repeat guest today. We got a good friend of mine. We got Miss Amanda Hahn. Amanda, welcome back to the show.
Yeah, thanks for having me, Rich. I love the podcast voice coming out.
We were just talking about that before. You said I'm the same personality off air and on air.
Pretty much.
Okay. But I think I noticed when like other guests come on, a lot of folks that come on, especially the ones that are like building their brands, the Grant Cardones, the Pace Morbys, the Ryan Pinedas, those folks I noticed when the lights come on, they do have another gear. So I don't know, it's interesting. I'll have to observe a little bit more closely now that you mentioned it.
Yeah, I do think you have a little bit more of an elevated gear, but I think it's still similar. It's sort of still that natural you, so it's the same. It is a little bit elevated.
Okay.
Yeah.
I appreciate that. So, Amanda, you live up in Orange County, Irvine, right?
Mm-hmm.
Okay.
Yep.
So you drove down the street. We got Avery Carl in office, in studio as well. So super excited about that. But you came on over a year ago now. What have you been up to?
Oh man, just busy with life and growing our CPA practice as well. It's really hard, when you're like a mom and also building a practice and I'm trying to grow my real estate just like a lot of our clients. So life is really busy. I was talking to a friend recently though who said like this is the time when it's really hustle and grind, but these are the times that it's like the most fulfilling. And like, when your business all is built and your kids leave the house, maybe you'll feel a little bit empty. So I'm really trying to, when I'm complaining to myself in my head, I'm really trying to consciously be aware, like these are also going to be the good years that I look back on too.
How old are the kids?
So I have a 5 and a 12-year-old. So big age gap. Not by choice, but it's kind of a surprise.
Yeah. You were on our Boutique Hotel Mastermind call a month ago and provided a ton of value. The members were like super pumped about that call. And afterwards, they were like, oh my gosh, that was a game changer. I learned a lot of different things on that call, which we'll jump into in this interview. So I'm excited for that. But I do have a question for you. So there's a few folks that are kind of in the space that live up in Orange County. Karlton Dennis is one of them. He's right up the street from me in Newport Beach. Do you guys collab and hang out?
That is such a funny thing that you brought up. So Karlton actually reached out to me on social media recently.
Really?
Yeah, I don't know what
that.
impetus. Maybe you were the connection, but yeah, he reached out recently because we're somewhat close to each other. So definitely looking forward to connecting with him. It's very difficult to find good CPAs who are tax strategists, and I think he is also, in the level where he talks about a lot of the same strategies that I talk about. So yeah, I'm looking forward to connecting with him because again, it's very rare to find CPAs who are creative like that.
Yeah, absolutely. And then what about Bethany LaFlam? Bethany is our SEC attorney. She was actually down here this past Saturday for our yacht meetup. I know you guys don't live too far from each other. Do you guys ever hang?
Yeah, all the time.
Really?
Bethany, yes, Bubble Bethany is what I call her, or she calls herself that. So she's a syndication attorney, and we in our client profile we have a lot of syndication clients. So Bethany and I have a lot of mutual clients where we advise them on the tax side of money raising, and then she advises on the asset protection side. So there's a lot of synergy there, and I just love her, as a female boss lady too.
It's funny because she's a big Weezer fan, and we were out on the yacht meetup this past Saturday, and there was a concert. Well, there's a festival going on right next to the marina that we're pulling into. And so after the yacht meetup, we're pulling into the marina, and Weezer is like literally performing. And we pull in, and there's like all these little boats that are in the channel because everyone's trying to watch this concert. And the yacht that we're on, Champagne Yacht, is basically stuck for like 15 minutes. We can't move, and we're just in the middle of the channel. But the cool part is like you look over to the left, and we were like right next to the stage, and Weezer was like performing, and there's a big sea of people. And so for 15 minutes, we literally got like a free show on the boat. And I know Bethany was a fan and she was pumped for that.
Yeah. Oh, you poor thing, you got stuck by the stage. So
Yes.
you can get the best seats in the house on the water.
Yes.
It's funny you bring that up because Bethany, I was joking that, Bethany told me it was like such a great time on the yacht. And I was like, well, I'm going to see Rich soon. I don't know why I didn't get invited to the yacht party. So I got to get on that email
Yeah.
list.
You are invited whenever. The next one is June 22nd. It's on a Saturday, 12 to 4. Come out. Would love to have you. It'd be an honor and a pleasure to have you out.
Awesome.
Yeah.
Maybe I'll have a concert and you can watch me sing from the stage.
Oh, okay. Okay. Are you a good singer?
Uh, the more I drink, the better I
Okay.
sing. And I haven't been drinking much lately, so I'm gonna have to say no to that one.
Okay. Okay. Well, maybe you have a glass of wine tonight with the girls on the team. Uh, but anyhow, so I have so many questions for you, and I've learned so much from you just in the past 12 months. But like one of the limiting beliefs that I had was I didn't realize that you could start a syndication or a fund as a 506c. I'm sorry, as a 506b, which allows you to bring in up to 35 non-accredited investors, but you can't market or solicit. And I did not realize until about a year ago that you could switch that opportunity into a 506c basically at any time, as long as you abide to a certain couple guidelines. And then you can, market and solicit and go out there and bring in the rest of the capital needed to finish off your deal after you've already got the non-accrediteds in.
Yeah. We have a lot of clients. I think that for me, the natural progression is we'll have clients who start out investing on their own, right? Maybe similar to you, have your own deals. Then you start partnering with maybe one or two other people. And, a lot of our clients, what I say is they're addicted to the tax savings, as you've probably, experienced, where you have real estate, you get all the tax benefits, and you effectively pay no taxes on your income. But at some point, for most of our investors, we hit a ceiling. It's like, I can only go this far with my money and the bank's money. I can only go this far with me and one partner. And so the natural progression typically is going to syndication
Hmm.
level. And I think that's where you start to scale your business on a pretty dramatic level, right? Because now you're working with an unlimited pool of funds
Hmm.
to be able to take on, larger, better, and bigger deals. And I think because we also represent clients on the other side as a passive investor, because we just have doctors, attorneys, other CPAs who still have their full-time job or business, but want to get into real estate on the side. So for me, it's really rewarding to work with people from both sides of that spectrum, the people who are syndicating, trying to scale that business, and also passive investors who are like, hey, I want to get the benefits of real estate, but I just don't have the time. And so being able to leverage a syndicator's expertise and network to get after those larger properties is really amazing too.
Yeah, absolutely. I always say, in order to scale a portfolio, you need two things. Everything else you can really delegate out, or you can hire a third party. But the two things are you need deal development, so you need access to good deals, and then you need capital development. You need access to capital. So it's either your own capital, or it's going to be someone else's capital. And everyone starts from somewhere. I had a 401k when I started, and that was my seed money to get started. I did two deals, and then all that money was gone. And then I started learning how to raise private capital. And some folks maybe they make a lot of money through their business or through their career, and maybe they have a little bit more money to start, and maybe they don't want to get into raising money because that's going to be a lot of work, right? It's a lot of day to day, and now you're being a custodian of someone else's money, and that's a lot of work. You get a report, so investors and all that sort of thing. It's not for everyone, and that's okay too. I love doing the smaller deals as well, where I don't have investors, and it's like those types of deals I can take a little bit more risk because it's just my money, and I would rather lose my money than investor money. And then the investor money deals, it's like I got to be a lot more selective with what I buy, right? And so there's pros and cons to both. But I think the real takeaway is like a lot of people don't realize when they get into real estate investing, myself included, a lot of folks think it's about the passive income and the cash flow, which is great. But when it comes down to it, real estate is really about debt and taxes. And so I think here in the US, we're lucky because up until recently, we had very, very tremendous debt. And although we are in a high interest rate environment, it's still, relatively speaking, compared to other countries, is a pretty competitive interest rate. You look at Turkey and some of these other areas. I mean, the interest rates could be in the 20s, right? And so, out in some of those markets, you really got to pay cash to make these deals work. But that said, the tax advantages of real estate investing here in the US are second to none. What are a couple tax strategies that you like in the commercial space and how it pertains to syndications?
Gosh, I think, from the sponsor's perspective, if you're a GP, you're the fundraiser, what we really like is, I mean, at least for current law, when you raise money in exchange, you get equity
Mhm.
in the deal, and which is currently not taxable, right? Not taxed currently. And so, also depending on how you structure it, a lot of times you're allocated the depreciation losses beyond any money that you put in as well. So it's a unique thing to be like you're saying, using debt and using debt to create tax benefits. So we see that a lot where we have syndication clients that maybe they put in $100,000 in this deal that they're syndicating, but their depreciation in that first year is more than the 200,000 that they put in because they're part of the sponsors of the fund. And of course, they get all the regular depreciation write offs and things like that. From the passive investor's perspective, I think this is really controversial because if you talk to a lot of CPAs, they'll tell you that as a passive investor, you get no tax benefits. And when you hear someone say that, it's because they're taking a very tunnel vision look and they're just saying, all they're really saying is, if you invest in a hotel or mobile home park and you get some tax losses, you can't use that to offset your W-2 income because that's kind of a passive investment. But what they're not looking at is the fact that this money you invested is generating cash flow and appreciation of which you're not paying taxes on. So if we're talking about a doctor who pays, 50% taxes between federal and state on his earned income, but the syndication gives him another $20,000 of cash flow that he's paying no taxes on, I think we can all agree that's some pretty significant tax savings.
Yeah, I totally agree. And it's not just the cash flow while you're in the hold period of these passive syndications as a limited partner, but if there's a refi event, so a lot of the deals we buy, we add a lot of value because we're buying them at discounts and we're adding tremendous value. So sometime in, let's just say year three, for example, we'll do a cash out refi at the higher valuation, and those refi proceeds are tax deferred. That's huge too. And so then by the time you get to the end of the hold period where you exit, you're likely in a scenario where you're not going to pay taxes on the cash flow and the refi proceeds. When I say tax free, but tax deferred. And then when you sell these assets, maybe you have an opportunity for the folks to roll their proceeds into. And I believe the 1031 exchange is an all or nothing thing. Is that correct?
I mean, for syndication, so that's also a misunderstanding. People think that in a syndication world, I cannot 1031 exchange. You can actually 1031 exchange in a syndication environment. It just works a little bit differently. So let's say we invested in, your boutique hotel deal one, that deal exits. Well, that syndication itself could choose to 1031 into another hotel or, residential or commercial property, right? So at the entity level, that could also be done. But there's this concept that we call lazy 1031 exchange. I don't know if you've heard of that before. So the lazy 1031 is where if I invested in one deal, it exits, there's a huge gain. And maybe I don't want to invest in this deal again. I want to take my money and invest with Rich now in his syndication. As long as I do it within the same year, then I could actually use my second investment to create that loss and offset the gain on the one that I sold. And so we have a lot of clients doing that. Like, we have clients who are nearing retirement age. And so these are people who've owned their properties for many, many years that they've self-managed. And now they're like, I don't want to self-manage anymore. I want to sell, but I also don't want to put my money in the stock market. I still want it in real estate. So most often these people are looking to roll that money into real estate syndications. And so this is where we use the 1031, the lazy 1031 a lot. Where like, okay, we got 100,000 or $1 million gain here. We're going to invest in some syndications. And if the K ones will give me losses, then I can offset the two.
I love that you deemed it the lazy 1031, but I also love it because it kind of gives the limited partner, whenever you exit the first syndication, let's just say there's a big gain, and it gives them two options. They can roll that into another opportunity as a limited partner. And then as long as it's in the same calendar year, you can use that new set of depreciation to offset those gains. However, the other option would be you don't even have to roll it into another investment as or a syndication as limited partner. You can roll that into your own opportunity as well, and then use those proceeds. I'm sorry, the new depreciation for the asset that you buy individually to offset whatever those gains would be. Correct?
Yeah, absolutely.
Wow.
So it's, I mean, yeah, that's what I love about real estate, right? It's so flexible. If you really think through it, there's so many different ways to offset taxes. So, I think when CPAs say there's no benefit to investing in syndications, it's really doing investors a disservice because they're just looking at something in under like a microscope of one little thing. And we have a lot of clients who, physicians is a really good example, where you might have a kidney doctor who also invests in an imaging center or a dialysis center, where those investments are kicking off very high taxable income for them. And so by investing in a passive real estate syndication, those losses will offset all that other passive income in that year. So this is an area where we see like a lot of mistake being made. Again, just because maybe the CPA is lazy and not looking at the whole thing, or, looking at different options.
Yeah.
Is this the only thing I'm looking at? W-2 income? No, I have all these other income that I make.
And I also want to mention, this is a huge takeaway for me, but I also want to mention this to the listeners listening to this right now is, realize that just because you're working with a CPA doesn't mean that they know what they're doing, especially in how it pertains to real estate tax strategy. Because I was working with a CPA before I got into real estate investing, and as I was getting into real estate investing, all these like tactics and strategies that I was learning, I was going to her and like showing her these, and she was like, "Oh no, you can't do that. You can't do this. You can't do that." The STR loophole was one of them. And so I found myself having to like coach her through these tax returns. And I also had to like, I was like having her work double checked by other CPAs that were more knowledgeable. And they're like, hey, she's doing it wrong. And so I just want to just shout that out for the listeners is like, don't assume that your CPA knows what they're doing. Their job should be saving you taxes. And so if you're bringing up some of these ideas that you're going to hear from Amanda on this podcast today, and they've never heard of it, or they tell you that you can't do it, you are working with the wrong CPA. I just want to throw that out there.
Yeah, and if we think about it, this thought came to me recently. And if you really think about how ridiculous it is that what you described, which is common by the way for people we meet, it's like, okay, I learned about these strategies, I heard it on Rich's podcast, I Googled it, I watched it on YouTube, and I bring it to my CPA, and then they'll tell me yes or no. When we have pain somewhere in our back pain or whatever, you go to a doctor, right? Isn't it the doctor who like diagnoses the problem and gives you a solution? We're never, just researching stuff and bringing it to our doctor saying, hey, doctor, I think this is what's wrong with me. I think this is the medication I'll take. Can you double check? Right? That's not how we do it in the medical world with our health. But nonetheless, it's so acceptable when it comes to taxes. It's almost like, oh, yeah, it's common. CPAs don't do planning. I have to do it and I have to bring it to them. So I really want everyone to just know that's not how it should be. And we really need to talk to our advisors and demand a change. I demand you to bring me strategies.
For sure. The last year that I actually worked with her was a few years back, and I had sold a property that I had, and it was a primary residence. It was just a one bedroom condo here in Lit, Italy that I owned and I lived in for 3 years as a primary residence, and then I turned it into a long term rental for 2 years, and then I sold it. And she had some like big tax bill for me for the gain, and I said, hey, my understanding is that if you live in the primary residence for any two of the previous 5 years, the first 250K, if you're single, is going to be tax free, right? And if you're married, it's the first 500K. And she said, yeah, I understand that. But because it was a rental for 2 years, it's going to be prorated, and you still got to owe taxes on the 2 years that you did not live there. And I was like, I'm pretty sure that's not true. And I was trying to say it in a nice way. And she's like, don't tell me how to do my taxes, blah, blah, blah. Like, this is how it is. And it was like a pretty big tax bill. And so I had to bring in like a couple other like tax strategists to just like shoot an email. And then finally she was like, oh, okay. And like she fixed it. But that was the last time I ever worked with her. So, and this is the scary thing is she at my air traffic facility, she did everyone's taxes and everyone was like, she's the best in the business. Like if you work with her, like she is the best in the biz, like you can trust her. And I thought that was a pretty simple thing. I'm like, air traffic controllers, they buy and sell primary residences all the time. And she didn't know that. I was like, yo, watch out. So, anyways, I just want to caution that for the listeners. If you are working with someone that doesn't understand some of the strategies that you're going to hear Amanda speak on, you're working with the wrong CPA, and it's time to pivot, because at the end of the day, their job is to save you money, not cost you money.
Yeah. And when we work with a new client, one of the things we do is to review prior year tax returns just to see if there's any opportunities. And I would say probably close to 40% of the time, we find some sort of issue with it, like something not being optimized. And a common story I hear, because I go on a lot of podcasts, and, podcast hosts like you are people who are very specialized in real estate. And more than a handful of times after the show, the podcast host will tell me like, yeah, my CPA is great. They're amazing. I love them. They specialize in real estate. And, a year or two later, they'll come to me and say, oh my gosh, I asked about, this thing to find out I never did it. So I think just always double check. Not that we don't trust our tax advisors, but talk to them about some of these concepts. If you're hearing about cost segregation or using retirement for real estate, don't tell them the whole story of how it's done. Ask them, what do you think about using my retirement money for real estate? Let them describe it to you. What do you think about cost segregation? Don't just take a yes or no, but I want you to describe to me what you think that is. How does that benefit or not benefit me?
That's really good. So speaking of taxes, I know there's something pending. What's the latest and greatest with the idea that they might bring back 100% bonus depreciation?
Oh man, I think this is gonna get me in trouble because I have to talk about politics, right?
I know, but
Um,
let's hear it, Amanda.
so yeah, so there's a bill going through Congress. The intention is to bring back 100% bonus depreciation. Right now in 2024, the current law is we have 60% bonus depreciation. So if we buy eligible assets, we get to write off 60% immediately. And then the remaining 40%, we write it off over the life of, 5 years or 7 years, whatever it is. And so the proposal is to bring back 100% bonus for 2024 and 2025, but also retroactive to last year. So for those of you who didn't file your tax returns yet, theoretically, we can have 100% bonus depreciation for last year. So we're all really happy because it passed the House like effortlessly with
A couple months ago, right?
yeah, months ago.
And what's the bottleneck now?
So well, now it's sitting in the Senate and
Okay.
it's been there for about 4 or 5 months. So there is, our thought process was it was going to pass, which is kind of waiting because usual government stuff takes forever. President has already signaled that he will sign as soon as it gets to his desk. But nonetheless, it's kind of just been stuck there for the last 4 or 5 months. And I get the alerts whenever that bill is picked up. So it kind of just gets picked up, put away, picked up, put away. So as of right now, I think there's good news and bad news. The good news is the bill's not dead yet, so still alive. It's still kind of struggling. The bad news though is recently, I don't know if you guys have followed this in the news, but recently, some of the Republican leaders have come out and said, even though this is a pro-business tax cut bill, which is usually favored by Republican Party, but if this were to pass, it would look like a win for the Democrat. And so maybe it's more beneficial to the parties to vote against it so that we don't give the opposition a winning score. So that was the latest and greatest in
And
terms of
this is solely just because the president in office right now is Democratic? Is that the only reason why?
that's kind of the inference that was made is like, we don't really, if we pass a bill, this is a bill that's highly popular, right? It's designed not just to help big corporations with write-offs, but also mom and pop real estate investors, smaller syndicators like most of our clients. And so because it's so popular, if it were to pass, it looks like a win for the current administration, which is, probably less favorable to the Republican Party who wants to be the next administration. So I mean, I don't follow politics in any way, but I do follow it from the perspective of taxes, right? Because tax is a big part of politics. But I just think that's a really unfortunate thing that, it's something that both parties really agree on, that majority of people favor, but we're letting politics sort of dictate whether we want it to pass or not.
Yeah. It is interesting, but I will say generally speaking, and I don't get into politics a whole lot or religion, but I will say generally speaking, liberals tend to like to blame landlords for housing crisis and that sort of thing. And a lot of landlords, generally speaking, this is not one all be all. Generally speaking, tend to be a little bit more conservative. So it'll be interesting to kind of see how this plays out, how it shakes out. I know we're in election year, we got a big election. I don't know how, man, but like somehow we got the same presidential runner-ups as we had in 2020. 4 years later, there was a lot of controversy back in 2020. And now we're running it back 4 years later, which is pretty crazy. I don't
Yeah.
know how that got happened.
Yeah. I mean, it's definitely going to be exciting to watch how that all comes out. There's another thought process that, Republicans, if we reject this bill, then maybe if Republicans do take control of Congress, then they'll bring back something again, bring this back later or better. So that's always if this bill were to fail, then that's something, a little bit of hope that maybe that will come back again in some form or fashion. But, usually in historically speaking on the tax side, if we have a benefit, it's much easier to extend it rather than to have it die and bring it back as something brand new, right? So we're always hoping. Of course, being retroactive is a huge thing. We have a lot of our clients that, investors and syndicators specifically, that even though our tax returns are done, we're not filing it because we're waiting to see if it comes back. It's a very significant tax difference,
It is,
whether
yeah.
it's, 80% or 100% bonus depreciation.
Yeah. It is a big difference, and I know the sentiment or the guidance from a lot of, tax strategists has been to hold off on filing. I know we did all the K-1s for our investors, so I know a lot of our investors, they wanted to file, they were waiting for returns and all that sort of thing. So we did them, and then if it does change, we'll just have to redo them maybe next year.
Yeah, it's a very tough spot to be in. We had syndicators texting us all the time, like, what's going on with the bill. But just so you know, the good news is, and if you, the IRS had said, go ahead and file your tax returns. If the bill were to be passed retroactive, the IRS will automatically make adjustments for you.
Oh,
But I
really?
think we can all
Interesting.
agree that the IRS is probably not capable of making such adjustments, because even if we talk about a syndication, right, they have to adjust the syndication return, and then they're going to automatically adjust all the investors. It seems like a big burden for them to do. So,
I completely agree with that. I think relying, on the government for any sort of aspect of, taxes or, anything else is gonna take a long time. We filed for the government or there's like a disaster relief program because of the heavy rains that happened in
San
January.
Diego, yeah.
We had some water damage at one of our properties, and so we filed for that thing, like, 3 months ago, and it's still, like, in application process. Like, we submitted everything, and we're just, like, waiting. It's been, like, forever, and I used to work for the Federal Aviation Administration, and, oof, if the public saw how they ran things and how slow their timelines were, I think, there'd be a lot of angry taxpayers out there, I'll just say that.
And that's the thing, right? So, on the tax side, like you were saying, right, people think like landlords are bad. Real estate, I mean, taxes are unfair for wealthy people for real estate. So I think, the current administration, there's been a big push in terms of increasing audits. As we all know, there's billions of dollars of additional funding for IRS audits. So I think there's a more fear in terms of audits on the rise, and what that means for investors. But I think one thing you said that was really interesting is, and we that also applies to audits, is like, even though the government has money, it does not mean all of a sudden they're going to get to hire all these amazing auditors who's going to come in with knowledge and do all this stuff, right? I think things move a lot slower than what we typically think. So I know there's a lot of fear about audits and CPAs talking about it, but the reality is, even though it's coming, it's probably not going to be happening like tomorrow, right? They got to ramp up and find people to do it.
I read an article that, the government is putting additional funding into, staffing out a larger team to, enable more audits. Is that what did they do exactly with that?
Well, so what they're doing is they're promoting a lot of people from within. So people who are maybe more junior level, we're seeing a lot quicker acceleration into more advanced audits, looking at larger partnerships, high income, high net worth individuals. But I think the IRS is going to have the same issue that I have and
What's that?
most CPAs have, which is lack of talent. And so for most CPA firms, from the investor's perspective, it's hard to find good CPAs. And it's the same thing for us as firm owners. It's hard to find talent who are people who are very technical on the tax side, but also strategic, right? And so we're all working the same pool of talent. So if we talk to most CPAs today, all firm owners, whether it's a small firm, a medium firm, or like the big four firms, talent retention, talent recruitment is the most difficult things. There's just not that many people out there who fit the bill. And IRS has the same issue. So they can get billions of dollars, but they're still going to have to find that person. And so a new person coming out of college, let's say, they have to decide, do I want to work for, Keystone CPA to do planning and help all these amazing, cool investors like Rich, or do I want to go work for the IRS, right? So on a big part, we're competing from the same pool. And I really don't think that the IRS is super attractive as a career path for all people who are graduating.
Yeah, that's an interesting, I never thought about it that way, that you could become a CPA and get an accounting degree and go and work for the federal government essentially and have job security, and even a pension. But that's a completely different path than going and working for, like, someone like Amanda Hahn. What is the pay like if for a CPA to go and work for the IRS? Do you know?
I haven't looked at into it recently since they passed the budget. I know one of their goals is to make it more competitive. But I know like when I was coming out of school, they paid a lot less than public accounting. It's like most government jobs, right? It's less of a salary, but the carrot that's dangled is the pension, the benefits, the retirement stuff.
You know,
So
I had the pension, when I was working with the FAA, and, if you work 25 years, you get a pension. But I always thought like, man, like, there's no guarantee that pension's gonna be there when you get there, first of all.
yeah, well now it's
Um
worse, right? From like when you were there
mhm.
versus now it's probably even
Oh,
worse.
totally. And so I did 11 years, and then I had 14 left. And everyone at the time, they told me, "Oh my gosh, you're gonna walk away from this pension? Like, you're fucking crazy."
Yeah.
And I'm like, looking back, I'm like, dude,
Are
like,
they now your
there's
investors?
now a lot of them are, and I love all of them. And this is no knock on the people that work there. However, I'll just say, like, what better retirement program out there than owning real estate that produces passive income that you don't have to pay taxes on? And oh, by the way, every 12 to 15 years, these assets double like clockwork, and you get to use the bank's money to buy these deals. Like, what better investment vehicle for retirement out there
Yeah.
is there than that? I don't think there is.
No. And if you think about even like for the next generation too, if you're leaving like, pension income, retirement income, your kids or your grandkids have to pay taxes on it. If you leave behind real estate and you do things right, they get step up basis. So you build a portfolio of, 10, $12 million worth of real estate. When they inherit that, not only have you utilized all the tax benefits, but they also don't pay taxes on all that appreciation in your lifetime. So it's so interesting how real estate can really create generational wealth. Not just like we always talk about financial freedom for ourselves, but we don't talk too much about generational wealth. And I think for even for a lot of our clients, like we have a client who, husband and wife, she was a teacher and he was a principal. So not like super high income tech guys, right? And so, but their plan was over the years, buy one or two rentals per year, and when they retired, it's like, their family, like their grandkids now are very well off financially because they took the time to build that side of, their portfolio.
Now, when you pass down real estate to your kids and you don't want them to have to pay this basis or this tax basis, it's called a step up tax basis. What
Yes.
exactly is that?
So the way it works right now in current law is that when we pass away, certain types of assets that we own gets a basis step up. So in other words, let's say we buy a property right now. When we're alive, I have a property I bought for $100,000 10 years ago. I hold it forever. Maybe I sell it. Maybe I 1031 exchange into a couple different properties throughout my lifetime. By the end of my life, when I pass away, let's say my portfolio that I started with 100,000 is now worth $10 million. And so if that property is in my name or my trust, when I pass away, my kids or grandkids inherit the property, their cost basis is now at 10 million. So it's no longer the 100 that I put in, now they're at 10 million. So basically now all that appreciation that happened during my lifetime, I didn't pay taxes on it. In fact, I took all the depreciation. So I didn't pay taxes on it. And when the kids have it, they now have $10 million worth of basis. So if they
Does that mean
decided
their
to
property
sell,
taxes will go off 10 million?
no, so this is we're only talking about income tax, okay? So their income tax basis is now $10 million, which means that if they were to sell the property, the first $10 million of sales price would be tax-free, right? So like I sold it for 11 million, my basis is 10, then I only pay taxes on the 1 million.
Oh, I see. Okay, so the step up base is a good thing for the generation that's inheriting the property.
Yes, because
Got
then
it.
they don't have to pay taxes on all of the appreciation in my lifetime, right? And so this is the strategy that most wealthy people use. They're like, hey, okay, I'm going to buy real estate. I'm going to get cost seg, bonus. I'm going to do all of the benefits. I'll keep trading up to bigger and better properties. And then when I die, my kids and grandkids will inherit that. And then they don't have to pay any taxes on. There is no recapture taxes, basically.
That's interesting. So they say 70% of wealthy families lose their wealth in the second generation and 90% by the third generation. So I think there's a disconnect in terms of like passing along these assets, but like not teaching them how to make the money themselves and passing along the knowledge. Why do you think that is?
I think it's just the way that people teach their kids, right, about finances and stuff. I do think that I know I've heard you say that statistics, and I've read that statistic before too. But I feel like those are maybe more old school, like maybe like my grandparents' age or even my great grandparents' age. It's kind of how people were brought up.
They didn't talk about money.
They didn't talk about money, and the grandkids don't really know when they get it. It's like, "Oh, I finally have it. I'm not sure what to do." But I know, like, with a lot of my clients, for example, they're very intentional about what their kids get exposure to in terms of money and what they expect their kids to do. So I definitely feel like, at least in, like, my generation or for a lot of our clients, I don't expect that to happen again.
Yeah, it is true. I mean, I have friends growing up where, like, at the dinner table as a kid going over to, like, their house, like, money was an uncomfortable thing to talk about, and it's just, like, one of those subjects that you just didn't talk about. But I also think, like, I think about this sometimes. I wonder, like, if some of it is because, kids are handed a lot of money, if they're, like, some sort of, like, entitlement a little bit, and so because of that, they don't feel hungry to go out and make it and hustle it and do it on their own because they were just always handed something. So I wonder if that's part of it too.
Yeah, for sure. But I do think there's like a personal, there's always like a personal benefit. I mean, a personal component to this too, because I think my grandparents had, a good amount of money. They were entrepreneurs. They built up a really good business in Asia. And my grandparents had 6 kids. So I have, my dad and aunts and uncles, and everybody kind of took a little different path. I have people, in my parents' generation that went out and mostly became entrepreneurs. And then there are others who were just waiting on family money, waiting for my grandparents to pass. So I think it's a little bit of both. It's like how you're brought up, but also just how you are as a person, how you apply yourself.
Yeah, that's really good. So I want to circle back a little bit. We were talking about the IRS audits. I'm curious, what happens exactly in an IRS audit? I saw Ryan Pineda got audited recently, and they're stepping up the audits. And I'm just curious, what happens in an IRS audit?
Yeah, it's funny because Pineda CPA is a good friend of
Oh,
mine, so
really?
we were chatting about that
Yeah.
as well. So yeah, I mean, it's funny because I think CPAs who are not strategic, okay, who just do file tax returns, what I tend to see is they like to scare the crap out of people with audits. It's like, don't take a home office, you'll be audited. Don't write this off, you'll be audited. That's always like something they're talking about. But the reality is, when there's an audit, at least in my experience, the auditors are usually pretty reasonable people. Like, they're there to do a job. They're not a monster. They're not out to get you. And if you can convince them of your position on why you did this, how this was a legitimate deduction or a write-off or a position, they're usually pretty good. Again, they're reasonable people. They have a family. They're just doing their job. So in an audit, usually what we try to do, well, the first tip is, if you're audited, always have your CPA represent you. Don't represent yourself. It's kind of like, if you're in real estate, don't sell your own property. Like, don't be at the property showing, that similar concept, because you're sort of too close to the scenario. And so the CPA could be your buffer. CPA will ask us what the questions are. We usually try to scope it out, like, what is it that you're looking for? How can I best help you get the answer you want and prove the case of my client? So usually you try to limit the scope of what they're looking at. And then we have a better idea of, like, okay, what are we working with? Usually they're looking at anomalies, like, you have a big expense item, prove to me it's business related. If you're claiming real estate professional, they usually want a narrative of what exactly do you do day to day, be able to kind of explain that or have a time log. But again, it's usually pretty civil. But I tell my team, when we work with auditors, treat them like professionals, like, I am here to make your job easy. I know you have a job to do to audit. My job is to protect the client. Let us know what each other's goal is, and let's quickly wrap up this thing if we can.
Yeah, I mean, I've never been audited, but I know it's gonna happen at some point, right? As we grow, it's just more, the likelihood that it's gonna happen at some point goes up and up. But I think it's like what you just said. It's like a lot of people are afraid of the police and, like, oh my god, I'm, like, afraid the cops are there. But it's like, as long as you're not doing anything wrong, what is there to be worried about? You know what I mean? And like taxes, I think the tax code is a lot of gray area, as you know. And it sounds like, as long as you're in the gray area and you have a good CPA that can justify your reasoning or your thought process, you have nothing to worry about.
Yeah. Well, but I will say there's no, like, guarantee result, right? Especially with a lot of, like, real estate, there's a lot of gray area. Even when we do, like, cost segregation, there's valuations involved. And so you could get an aggressive auditor who's like, I am the law, right? Like, the I am King Kong kind of thing. And then you decide, you go to appeals, you go to court, or do you settle? But like anything, it's a business decision. I always tell clients, don't decide to not to do something because you're fearful of an audit. That's where planning comes in. If we're planning ahead, that means you know what to do and you're doing the right things during the year to document all these things. So if we're audited, we have a higher, we have a high percentage of winning. the people who are afraid of audits are people who don't do planning. It's like, oh, well, I think I was a real estate professional. I'm not really sure. Can I just make up my time? Can I just say I did it even though I didn't? Those are the people it's like, hey, if you're audited, think about how you're going to prove it.
Yeah, we got cost seg studies done on all the hotels in our fund, and I always tell the cost seg study companies we use Madison Specs. Shout out to Madison, and I've used them for all the properties, even the single family short term rentals, and then the larger like multifamily deals in the hotels now. And I always tell them like, hey, like get aggressive with the depreciation. And our CPA was like, hey, like for one of the hotels, it's a little aggressive here. What do you want to do? Do you want to bring it back? And I said, no, I want that. This is investor money. This is their depreciation. Like I want to maximize their depreciation. And if it comes back, it comes back. But like for something like that, I'm like, okay, there's a cost seg study that we leaned on, we hired,
Yeah.
right? That's
Right.
their report. They're the expert. I have no idea how to do that stuff. I have no idea how they derive those reports. That's like not my lane, right? And so if that's what they gave us and they signed off on it, like let's use it, right?
Yeah, that's interesting that your CPA, like your old CPA, would have asked that because I take your position, is that the client hired a cost like expert. I am not an expert, otherwise you would pay me to do it, right? I'm not an appraiser. I don't have valuation stuff, and so yeah, we rely on what the cost like firm produces because I've had audits where IRS will look at a cost segregation report and I'm not even involved in that piece. My client is not involved in that piece. They have direct access to the cost seg firm. So if it's Madison Specs, they'll talk to Madison directly. And then they'll walk through exactly what they do to do the valuation. Some of those things, especially for hotels and stuff, it's not super cheap. So there's a lot of work involved. And honestly, I think we give auditors a lot of credit. Many auditors don't really even understand real estate. So cost segregation, depreciation itself is sort of like a big thing. And for a lot of them, it's a learning. They're like, oh, I didn't even know we can do this. And so they kind of learn on the job as they go, where the cost seg firm is teaching the auditor, like, this is what's going on. So which is a good thing. We want the auditors to also, learn some of these strategies too.
Yeah. And we bought a deal in December of last year. And I know a lot of investors got in, like literally like in the last month of the year because they needed some depreciation. So I'm like, I want to
Were those some
maximize
of
it.
my clients?
Yeah. So I'm like, it's my job as the sponsor to maximize the depreciation for my investors. And so I was like, let's go with it. And they were like, okay, like let's do it. So anyways, I was just curious on how that goes. But they shout out to the CPAs. They busted out those K1s really quickly. They turned them around. They're actually out of Miami and they're actually here for the meetup.
Oh,
They were
okay.
actually
Yeah.
in office yesterday and they're gonna be at our meetup tonight, so I'll introduce you.
I know your CPAs.
Yeah? Okay,
Yes. I
okay.
think I might have connected you guys. I don't know.
Oh, maybe,
Yeah.
maybe. Yeah.
No, so they're great. Yeah. So we're talking about the same firm that's currently doing your taxes. They're amazing. I have no doubt that they know what they're doing. They specialize in real estate. And that's the tough part. I mean, for me, it's easy to know if a CPA actually specializes in real estate or they just say they do. Because I think when you interview a CPA, everybody will tell you they do real estate. But that could just mean like they have one person who owns one rental property, right? But especially if you're syndicating, you want to know, do you have experience in syndication real estate? Because even syndication is a whole different set of strategies than short-term rental portfolio, right?
100%. If you love real estate investing, passive income, and tax benefits, but don't have the time, my company, Summers Capital, is buying boutique hotels right now. We source the deals, we renovate the properties, and we even handle all the day-to-day management, making it truly hands-off for our investors. If you want to learn more to see if we can help you, visit summerscapital.com/invest to book a call with our team. Again, that's summerscapital.com/invest. Now back to the show. So I got a question for you. This is something that I'm actually doing right now. So I'm in the middle of an exchange. The the down leg is under contract and the up leg is also under contract. And what I'm going to do is I'm going to take the proceeds to buy the up leg, right? And I'm using a 1031 intermediary. They're called, what are they called? I've used them before. Lanco Exchange. They're actually out of Orange County. Have you heard of them? Okay. Anyways, so my question for you is this, and I haven't gotten any guidance on this. You're the first person I've asked.
So free
But
tax advice for Rich on the podcast.
yes, yes. I love you, Amanda. You're amazing, by the way. And okay, so I want to use most of my proceeds to roll into this next deal, but I want to take some of the proceeds back So if I'm just taking my down payment back that I bought that deal with initially, how does that work? Will I be taxed on, like, how does that look like on the tax? Let's just say for simple math, I put $150,000 down on this deal and the sale proceeds are going to be $500,000. Can I take my 150 down payment back and roll the other 350 into the up leg and not have to pay any taxes?
Well, you could if you did that in the exchange and it becomes a taxable event. It's
Even if
what
I just taken my down payment back,
Yeah,
even though
it's
I
what
already
we
paid taxes on
call
that down payment before I bought the deal?
Yeah, it's called
Really?
boot. So in a 1031 exchange, the whole concept behind it is no cash out, right? If you cash out, then you've gotten a current benefit of it. And
Even though
so
it's your original investment, you're just taking them back. I didn't
Mhm.
know that.
Yeah,
So
so that's
what tax rate will that
it's just
money be
capital
taxed?
gains. Yeah, just regular
Which would be
capital
what,
gains.
15%?
15 depending on your total income. So yeah, it could be 0 to 20%, somewhere in between or 15.
Now, if I have all this depreciation from other stuff that I'm buying, then it'll wipe that off.
Exactly.
Okay,
Yeah.
so I don't need to worry
So
about it.
so it could do it. But let me give
Look
you
at
okay,
that.
maybe here's a better
Look at that. We're still
strategy.
zeroing it out
Yes. But here's
on the
maybe a better
podcast.
strategy. So when you do it at the time of the exchange, it's considered taxable, right? Because you've cashed out. But if you did the whole exchange with no cash out, once it's all done, you can then do a cash out refi. Then that will be a regular refi. So you wouldn't have any
Mm,
taxable gain at all.
okay.
So of course there's the cost to
Of
do a
having a
cash out refi
refi or
later.
wait. Yeah,
So
yeah.
that's what, you and your CPA can get together and kind of analyze what is the cost. Because if you naturally have other losses from syndication, real estate, then maybe we don't care. You just do a cash out. But if you want to preserve those, maybe you have other income, acquisition fee income, just other income from the hotel that you really want to use the depreciation for all that other income, then maybe consider this other way of do a true 1031 and then do a cash out. So you preserve kind of all those tax benefits.
Interesting. Okay, so it sounds like either way I'll be good because there's another component. The seller of this deal is going to finance. They're gonna carry 150 grand in second position. So I was wondering. I was like, okay, well, do we just maybe do a promissory note on the back end with that money? That way I can put all my 1031 proceeds into the deal, and then we can do a promissory note kind of off the table for that. Or do we just include it? So I'm like, okay, well, if we include it, it's not really that big of a deal now, just based on what you said. I mean, this deal that I'm buying is about 1.65. So let's just say 100% bonus depreciation does come back and I do a cost seg. Let's just say roughly get 30 to 35% on that 1.65. We're looking at about 450 to $500,000 in new depreciation for the 24 tax year. And that would offset the 150 grand that I pull out. So I don't have anything to worry about. And I have more depreciation outside of that from the other assets. So I probably should be fine. But I wanted to run that by you. And now I feel a lot
Yeah.
better.
When I think you want to look at the whole profile too, because you have more income than just this transaction, right? So the question is, well, what is your other income? What is your acquisition fee? What is, all the other income that you get? Because I think one sort of mistake people make is like, oh, I have depreciation, I can offset it. But we also want to look at, well, if we didn't use depreciation for this, can we use it for that or future, right? So we want to be smart too about overall or multi-year planning wise. How do I make sure I keep all my benefit? Because for most investors, your income is going to keep going up, right? You have more real estate, but you're also going to have more acquisition fees, asset management fees, realtor commissions, whatever it is that,
Yeah.
people are doing, right?
Okay, let me throw another one at you. Two of the companies, one of them is Summers Capital, and then the other one is Excelsior Stays. That's our hospitality brand. That's what we use to manage the short-term rentals and the boutique hotels, and we also manage for third-party clients. So that has payroll. We have VAs, and then we have in-house payroll, and then we have payroll on Summers Capital. But now we have a online community that's like a cash business, and that doesn't have any overhead, very low overhead, and it's a cash business. Would it make sense to assign some of the payroll because some of the team members are working in that online community? They're spending hours on that, but it doesn't technically have payroll on paper. Would it be smart to move a lot of the payroll expenses over to this online community business because it's bringing in so much cash and it's not really tax advantaged money income?
Possibly. I mean, I think you probably want to do it outside of taxes. You probably want to do it just from a, like a management perspective, right? Because if your people here are spending money on that business, then you want to know, like, how profitable is that business truly? What is my cost to run that online business? Right now, like you said, the cost is 0, but is it truly 0?
It's not truly
Is it
zero.
worth
You
my
could
time to keep doing
Yeah,
this,
there's
right?
marketing expenses. I mean, you could argue this podcast, media, social media, all that stuff is marketing, right? So, okay,
It could
but
make sense to like cross charge it, right? So
okay,
okay, here's a reasonable amount. My girls are working there X number of
50%.
week. Yeah, so maybe half the payroll should be cross charged. You can still run your payroll here instead of running two
Oh,
payrolls and do all that mumbo jumbo. But yeah, I'll definitely look at
and
cross
so that would mean
charging.
50% of the payroll taxes as well would be
It's still, yeah, be
come out of
here,
there.
but then you decide, right?
Yeah.
That's how I'm gonna cross charge like a management fee or something like that. So again, I recommend that, not necessarily from a tax perspective, because you're paying the amount of payroll, right? So whether we say it's here or there, it's the same dollar amount. But it's more from from a business management perspective. So I know really how profitable is it. So we don't have one business with all the costs associated.
Yeah. Yeah, yeah. Okay, one last question for you, and then I'm gonna jump into a bunch of other stuff, but,
And then all
this
the
is
other
this is a
questions.
personal tax strategy. I guess this is, like, for the whole team, but, okay, I'm curious, and, I'm buying my first boat, and,
Awesome.
yes, and it's gonna be I figure I can justify it because I think, we can go on the water, we can take investors out there, we can take community members out there, we can take the team out there, we can even throw some, like, meetups and, like, VIP events out there, so I think I can use it, and then from a branding perspective with the content, there's no doubt that you're gonna get more views with a boat, and so I think it could be a fun thing. We could do a lot of team trips, and so I wanna buy it, I'm thinking about buying it under, the Summers Capital entity. Is that the right way to do it? And can you depreciate or use as a write-off, like a marketing expense for the company?
So yeah, for boats, usually it's going to be depreciation instead of like a full write off, right? Just kind of similar to real estate. We can use it for
Because it
multiple
would qualify
years.
under code section 179? Okay.
Yeah, yeah. I mean, so you'll take depreciation on the boat rather than just like regular expensing. Now, whether you have it under Summers Capital or another entity, there's no real difference from the tax perspective. But what I typically see with my clients who have boats and things like that, they usually have it in another entity. And my understanding is usually just from an asset protection perspective, things could go wrong on a boat.
Right. So I was gonna do and the yacht broker told me to buy it with its own individual entity, but I was thinking of having that entity owned by Summers Capital. I don't know, is there an advantage of that? But, they were saying because when I go to sell the boat down the road, if I sell it with the LLC to the new buyer down the road, that they won't have to pay sales tax.
If you sell so you sell the buyer the LLC instead
Yeah,
of
and they
selling
won't
them
have to
the
pay sales
boat,
tax on the
right?
boat
Yeah.
versus, if I just sold them the boat, they'd have to pay sales tax, meaning, I could probably sell it for a little bit more if they didn't have to pay sales tax.
Yeah, yeah. That makes sense to me. But I think the question really is, so I think we're all in agreement the boat should be in its own LLC, not directly in your
Yeah, if
business.
someone gets hurt,
Right,
I don't
right.
wanna be liable, yeah.
So the question really is just should the LLC be owned by you or should the LLC be owned by your business? And I think that's probably a better question for Bethany or, asset protection attorney, because that's what that conversation is going to be about.
Now, let me
How do
ask you this
we
though, and you can answer
bifurcate?
this. If the LLC is owned by me, can I still justify and say, "Hey, this boat is a marketing expense for Summers Capital"?
Sure. I mean, we would do it in the way where it's like the boat itself is it's an entertainment LLC, right? So you're paying the boat LLC for the use of it for events and things like that.
Okay, so it's almost like I'm gonna take advantage of code section 179, and so I'm gonna be able to depreciate the boat. However, what would be this other write-off if I was like a marketing expense? You're saying like that cost could apply towards other active income if it was marketing.
So no, that's just saying like if, like you're doing a team meeting, so your S corp is gonna rent the boat out. Like right now, you're renting a boat from Champagne, whatever company, right? So instead of doing that, you're just renting from your own LLC, right? It's an entertainment. For your business, it's an entertainment expense. It's income to the LLC now, right? Where the boat is coming in. And then whatever depreciation for that year will then offset the income, right? The marketing income that it
Yeah.
generates. Yeah.
Okay.
But, yeah, I was thinking, like, it's about time you have a boat. You're gonna get a black boat? I
It's
didn't do
actually so
yachts come in black color?
yeah, so it's actually a new boat. It's 2023. It's Bavaria makes it. It's a German manufacturer. They make really good quality like boats. And yeah, it's got like two staterooms. It's got a head galley. It's really cool, like boat, comfortable. It's about 40 feet overall, twin diesel. And it's white. However, I want to get it wrapped in black. My buddy's got like a wrap shop. And so he said he could wrap it, and I want to like wrap it in black and like have a really like catchy like name to it. So that's kind of the plan. So we'll see. This will be the first one. It never really made sense, and I could never justify it. But I think now I can justify it, and I can use it as a tool to make money or to make more money. And I think it'd be a big win for the team, the investors, mastermind members. We can do some cool stuff on the boat, and we can do some like, just some cool like retreats and just like excursions on this boat. And that said, it will be fun. And like, why not? We live in San Diego. The weather's good here year round. So like,
Yeah.
why not? And
Yeah.
life is short. So I'm like, let's
Yeah.
do it. Why
Yeah.
not?
I think you'll get a lot of good use out of it. And I definitely think it's really good for branding and all that
Mhm.
stuff. Now I don't know if it's eligible for 179. I'll have to look at it and get back to you. But I mean, if your CPA says it is, then I'm gonna assume it is. But yeah, I mean, I think there was a time when I saw a boat out in San Diego that was black, and I was thinking about, I was like, I wonder if that's Rich's boat.
No. We were out on my buddy's a broker. He took us out on a boat like a month ago, and some of the girls on the team were out with me, but it was a black boat, and it was fun. He was trying to get me to buy that boat, but it wasn't quite everything that I was looking for, so I had to make a pivot. And when you work with like a yacht broker, they typically sell new boats. And if you buy like a used boat that's not one of their new boats, they can represent you on the buy side and get a commission. But if you go and buy a different new boat from another dealer, they're not gonna be able to represent you. And so I'm buying
Interesting.
a new boat from another dealer, but because it's the right boat that I want,
Yeah,
which is the most important thing. But unfortunately,
of course.
I'm not able to use them. But I told him, I said, hey, I'd be happy to come out and do a little content, collab. Maybe we can do like a meetup. Cause, the interesting thing is like our investor database and like our investor community is really the same demographic as like these yacht dealers, like customers. These customers, the clients that they have that are buying these, 500,000, million, 2 million, $3 million yachts. These are the same demographic as like our investors. And so we were thinking, well, what if we do like a yacht meetup on the dock where he brings all his nicest yachts, and then we do like kind of a collab meetup with like a little wine tasting. Come check out these nice yachts and hang out in San Diego. I think that'd be a pretty fun meetup to
Oh,
host.
that's an
You
interesting
know?
idea because people do like car shows and stuff
Yeah,
like that. I've
exotic
not
car
heard
shows.
of like a yacht show. Is that a thing down here?
It's interesting. So it is. So it's funny. So when he does these like yacht meetups, he'll work with like like one of our investors is the manager of the Ferrari dealership, and his name is Scott. Shout out to Scott. But he'll partner with some of these like exotic car dealerships, and then they'll bring all the nice cars out, and then they'll have the nice yachts, and they'll host a meetup, and they'll invite all their clients, and they're kind of like, it's kind of the same demographic. It really is. But I'm in an exotic car club called Fastlane Drive, but I don't know, I would say that group is not exactly the same group that's buying these
As
yachts
the yacht group?
and in our investors. I don't think they are, but it could be. But generally speaking, I think the folks that are in this exotic car club, mostly a little bit younger demographic, I would say. The ones that are out there ripping these we do these drives, and they're really fun. But like a lot of the ones that are ripping the drives, there's a big group of like younger. I would say when I say younger, I'm like 30s to 40s, you know. And I would say a lot of our investors are like in their 50s and 60s. You see what I'm saying? But the 60-year-olds are not the ones ripping these drives, going 130 miles an hour. You know what I mean?
Yeah.
So I don't know if it's the same demographic, but I'm trying to figure that out still.
Yeah. I
Yeah.
think it's so interesting. Like we see this a lot with our clients too. Like, as you get into more like higher level real estate, start doing syndications, and there's just so much more opportunities in terms of like building wealth and also tax savings, right? So you're in these clubs with people who then are your friends, like your good friends. And so you go from like when you're a W-2, you can't write off anything to now then like, like a big part of your lifestyle becomes a deduction because you're really just doing business with everybody that's around you, right? Like people in your club, they're also like your investors and, maybe you're going to sell them something. So it's really interesting how that all works together. And the law really incentivizes you to do that, right? They want you to be creating deals, creating housing and doing all this stuff. So
Yeah, absolutely. So I got to ask you, this is probably the most trending and viral topic around real estate investing and taxes in terms of a tax loophole. I got to ask you, I want to talk about it for a little bit because I've done a handful of deals with this. What exactly is the STR tax loophole?
well, you're gonna have the STR queen here right after me,
I
right?
know.
For Avery Carl.
Yes.
All right. So short-term rental tax loophole. And, I sometimes I've talked about it on social media and I get some hate comment and they're like, it's not a loophole, it's the law. But I actually believe this is a loophole because I don't think the IRS intended it for it to be this way. So we call it a loophole because in a natural investment environment where we're investing in long-term rentals, which is, apartments, mobile home parks, all the usual stuff, right? If you have a long-term rental investment and your income is your high income, which is over $150,000, your rental losses from cost segregation and write-offs and all that, those are passive losses, which means, like we said earlier, you only use it to offset passive income. So, other investments, rentals, and things like that. We don't get to use it to offset W-2 income in the current year. And so for a lot of people who are high income earners, they're upset. They're like, well, I have all these losses and I have all this income and they never touch each other. And so the only way for them to touch each other is if you or your spouse is a real estate professional. And there's a whole slew of rules around that. But one of which is you have to spend more time in real estate than your job. So for, I don't know, anybody who works a full-time job, it's very difficult to have more than 2,000 hours at your job. And that's where the short-term rental loophole comes in. So when you invest in the short-term rental, we no longer care how many hours you work at your job. So real estate could be like a side hustle. You can potentially use the short-term rental losses against W-2 income as long as you meet material participation hours. And this is why we call it a loophole, because I don't think the IRS intended for it to be this way. It was just kind of that was how the law was written. There were court cases about it. And so now we just, go around using it. And this works really well for a lot of our clients who are high income earners, in tech, business owners. We have clients now in the entertainment space that are getting into short-term rentals because they're not going to stop being actors or doctors to do real estate, but they do want to have an amazing short-term rental. They want the tax benefits. So that works out really well for people who make money that, outside of real estate, but want to save taxes using real estate still.
Yeah, I love it. And as far as I know, it works for a hotel as well because a hotel, as long as the average guest stay is less than 7 nights or 7 nights, is it 7 nights or less than 7 nights?
I mean, in a traditional short-term rental route, it's 7 days or less to be average guest stay. For hotels, we actually don't really care. Usually it's 30 days or less. So you can have longer guest stay
Really, for a
hotels.
hotel because it's just more active,
It's
hands
just
on.
exactly.
Okay,
So for somebody who tells me they invest in a hotel, it's always gonna go under that loophole. And there's not a name for it. I think we should come up with a name right now. I don't know if it's like the
oh,
boutique
we totally
hotel
need to.
loophole. But it's just like the short-term rental
We
loophole,
totally
but it's
need
a little
to.
bit different, right? It's a little bit different because we're not talking
I didn't even
Airbnb.
think about that. Okay, we
Yeah.
got to deem one.
And we'll trademark it.
Yeah, we need to. We need to.
But yeah, that's what I love about like we have more clients that are part of your community too that are getting into the boutique hotel space, and it's really really interesting because a lot of people don't know. I think people don't talk about the fact that when you invest in hotels, it is very similar to the short term rental loophole where you can have a full time job, and hotels get huge cost segregation benefit too, right?
Yeah, so we'll have to come up with some sort of
A
name
cool
for this.
name.
I don't know if we're going to call it a boutique hotel loophole or what, but I will say that most of the folks in our online boutique hotel community, most of those members are actually, they work a full time W 2. And so that is a good tax play for them. Yeah, I don't know. I would say some of the best investments I had were when I was still working the full time air traffic control position. And I bought a couple short term rentals and I bought them on no money down Navy Fed credit union loans. I lived in them for a little bit. I negotiated the sellers to cover my closing costs, so I got in them for a true no money down. One of them was already furnished, so I didn't have to buy furniture. And I lived in them for a little bit, and then I turned them into short-term rentals. And I was still working my full-time air traffic controller job. And then I got cost segregation studies done on both of those short-term rentals. They paid me every single month, and then I got to use the depreciation to not only offset the income that those properties spit off, but also offset my W-2 income as an air traffic controller. And the last year I worked there was 2020. I did about $210,000 with the overtime. So I paid like a pretty high tax rate and everything was zeroed out because of those two rental properties.
Yeah.
It's a powerful play because of the STR loophole.
Yeah, for
Yeah.
sure. I mean, we have clients who, I was telling Avery because it was the client who invested with Avery Carl a couple years ago, two short-term rentals in Tennessee. They're in the healthcare industry, and now, I mean, he's still in his early 30s and he's like semi-retired. Just from those rental properties, cash flow, tax savings, appreciation, refi built upon that. People think like, oh, all these guys making so much money in real estate, they must have come from like trust fund babies. But there's so many stories just within my clients that are like, they started like any other person,
Totally. Yeah.
in healthcare and air traffic or, whatever
Mhm.
it is. It just takes like one or two properties to start the momentum
Yeah,
going.
absolutely. I wanted to pivot and talk a little bit about Code Section 179. We know that there's a lot of vehicles out there that qualify for Code Section 179. I bought a G-Wagon on December 31st of 2023. Rolls-Royce Ghost, the Rolls-Royce Phantom, I believe. A lot of these higher-end SUVs qualify. Lamborghini Urus is one of them. So what exactly is Code Section 179 and how can it be utilized to save on taxes?
Gosh. Well, so 179 is basically part of the depreciation code that says for certain assets that you buy for your business. I know we're talking specifically about cars, but it really could be anything
An
used
airplane,
for a
could be a jet.
business. Yeah, it could be airplane, could be I don't know, this desk or
Yeah.
whatever, right?
Grant
So
Cardone's got a Gulfstream 650 ER, and that qualifies as well.
it's your ability to take an immediate write-off. Similar to what we're talking about with bonus depreciation, 179 works exactly the same way. It's saying instead of writing it off over multiple years, we'll take a bigger upfront deduction immediately in this year. But with real estate investors, I think most commonly what we see is when we talk about, vehicles, right? So using bonus and 179 to get the big tax benefits. So when our clients are buying vehicles, if they're going to use it predominantly for their real estate business, then we always want to know what, year, make, and model of the car, because we want to know if it's over 6,000 pounds. That's for some reason the government incentivizes us to buy larger, heavier SUVs and trucks like that. But yeah, I mean, we have clients who are like, hey, I really want to be more fuel efficient. It's like,
Mhm.
unfortunately, those don't work as well.
No, no, not at all.
Maybe there's gonna be a change to that, like, hey, all kinds of cars just qualify as long as you use it for real estate or
So what
business.
are the stipulations? So 6,000 pounds, and you have to own the car for at least 5 years, correct?
You don't have to own it for any number of
We
years. It's
don't.
just that when you sell the car, so if you were to sell a car, then there might be depreciation recapture, right? Because, you've taken a deduction for it. But yeah, and the other thing that people are maybe misled sometimes, because I've heard other CPAs say this incorrectly, is they're told like, you can buy a car this year, December 31st, drive it only for business. Next year turns it into a personal car and you're totally fine. That's actually
It
problematic.
has to stay as a
It
business
the
vehicle.
stay it has to stay as a business vehicle. Otherwise, if what I just described happens, then the following year you do have depreciation recapture, which is not always wrong. It's just we want to understand, when we buy a car, if we're using it predominantly for business this year, we want to try to also use, it doesn't have to be exactly the same, but a similar amount. We don't want to all of a sudden just have it be 100% personal use.
Yeah. So, I know last year I bought it December 31st, 80% bonus depreciation was still in play. This year it's 60% bonus depreciation. So it'd be interesting to see if you were a betting lady, would you say the 100% bonus depreciation will or will not come back?
If you asked me a month ago, I was betting yes. Now I really don't know. I think I'm still leaning towards yes, because there are still more talks from the politicians that are like, oh, I definitely want to support this. So I think there is a likelihood still of it coming back. I think people who are in legislation, they all understand like what I was saying, like, yes, we can let it expire and bring back something new or different, but that's much harder than just saying, "We liked it, let's extend it." Like, what did bonus depreciation do for us economically? And if we believe that it did all that good stuff and we really need it now, let's extend rather than drafting a whole new thing for people to work, vote on.
The Biden administration is looking at bringing or introducing, basically tax on unrealized gains. I think that's a pretty interesting thing if it did get approved. I know it's only for high income earners. What's the threshold there?
I don't even know. It's funny, I was just chatting with my friend because we were talking about all these proposals. And the reason I've not talked a lot about it, even with my clients, is because the likelihood of any of these passing is slim to none. And so, I think for our clients at least, they're very busy with real estate, with their family, and with all the tax stuff that I want them to do, that I don't want to burden them with some of these like potential things that are very unlikely to happen. Biden is talking again about limiting 1031 exchange. I think last time I was on here, we talked about it. We've talked about it every single year.
What's the
And it's,
likelihood that gets
I
approved?
mean, again, slim to none,
Yeah.
right? that is maybe a little bit more likely than this unrealized
Yeah.
gains
Well, and
tax,
I read
but
that, like, if they eliminate the 1031 exchange, that you'll still be able to do it for, like, I think just like 500,000.
like a
But
million, I think is what they're
most of
saying
these
now.
deals, that are traded, that execute these 1031s, especially these larger deals, I mean, these are much larger, sale proceeds that are being rolled over than, 500K or the $1 million threshold. So that would be interesting if it gets approved.
Yeah.
I don't know.
I think if you
I
look at holistically, holistically, a lot of the things in the Biden proposal are negatively impacting real estate investors. So the limitation of 1031 exchange, they're also looking at, basically depreciation recapture, all going to be at ordinary rates. So regardless of whether you do accelerated or not, when we sell, just basically higher capital gains rates, and then increasing the capital gains rate. So if you combine
and
those three,
and capital gains tax on unrealized gains.
right. So if you look at all of those, just as an investor, like what does that mean? That means I'm not going to sell real estate, right? I'm going to sit on real estate. And so what does that do to the market? I mean,
It pushes pricing upwards,
yeah. So it's really,
makes
really
things less
crazy.
affordable.
Yeah, less affordable. I mean, I think the
Or
government is,
there will be a big sell-off before this gets implemented, because they'll announce it, and they're gonna say, "Okay, starting in 12 months,
yeah,
this is
or
the new
in
rule,"
three
and there's
years.
gonna be a massive sell-off in between that time,
Yeah, for
right?
sure. Yeah. I mean, I think for the, I think for most people, it's like, well, what does this mean, right? Amanda and Rich, you're talking about all this stuff may or may not happen. What does this mean? And what we tell our clients, like, oh, here are the proposals. We don't think it's going to happen, but if it's going to happen, and like you said, they give us some time to maneuver, what should we be doing today? And what we're telling our clients to do today is to look at your portfolio and say, if this were to be enacted, which are the properties I'm going to keep forever, like keeping
Mhm.
for step-up basis in the
Yeah,
future,
and if you're gonna sell, sell now.
and which ones I will be ready to sell if and when this were to be enacted, right? Because that's the part we can take out now. We can say, okay, let's think at the portfolio and how would we kind of bifurcate between these two categories. But we're not recommending people sell or, we're not recommending any crazy moves. Because again, I am of the belief that the likelihood of anything in the proposal is very little.
Well, there is a shortage of supply out there, so if they want to, increase the supply of housing and real estate on the market, I think that would be a good way to do it. That would be pretty scary, though, if it got approved, some of those things, especially the capital gains tax on unrealized gains.
Yeah.
I mean, that's
Where would you get the money, to pay the tax?
I don't know where
It's
you
a
would get
forced
it.
sale. Well,
Yeah.
you're forced to sell something
Yeah.
to pay the tax. It's not going to be
Right, where would you get the taxes? It's like you're paying taxes on money that you haven't even received yet.
yeah,
Yeah,
exactly,
so I don't
exactly.
know. It'd be interesting to kinda see how that would work, but
I think the
it's like,
talking
okay, if they're gonna give us a tax on unrealized gain, if they're gonna tax us on unrealized gains, we want a return on unrealized losses.
yeah,
How about that? You gotta play both sides of the coin there.
yeah. It'd be a good business to go into, just always calculating a fair market value of everything
I
every
know.
year. But yeah, it's interesting. I think it's a good talking point from politicians' perspective, like raising taxes, the rich pay too little taxes, but the practicality of it, what does that actually mean for the economy? I think that's the big piece of it. That there's a organization called taxfoundation.org. It's really for tax nerds like myself. But if you're ever interested in learning like how tax policy impacts economics, it's a really amazing site to visit. And it's not a political party, it's just like an independent nonprofit, and they do all these analysis on like back in the days, like historically speaking, when rates go up, when tax rates go down, what happens. I think so clear that when tax rates are down, when there is incentives, the economy does well, because like
Yeah,
as investors, like
I agree.
we're happy to
Creates more
spend our money.
jobs.
When investors save money, like an investor got $100,000 tax savings, they're not going out and buying a big diamond ring. Like most of my clients, they're not going out and buying a diamond ring. They're going out and investing in more properties, more real estate, improve their properties, which is the intended purpose of those.
Yeah, I agree. I think, a lot of people don't realize it's like, well, when the rate environment goes up, they're really taking money out of the economy, taking chips off the table. And then when the rates go down, it puts a lot more money in the economy. So right now we're in a higher rate environment. And so we'll see where these rates stabilize. We're all speculating at the end of the day, but I think there's going to be a lot of news unfolding because we're in election year. So it'll be interesting to see how everything unfolds between now and in the next 7 months. But time will tell. And I think the only thing that we can control is what we can control. And so I think given the economy, given the political climate, given the interest rate environment, like there's just things are going to happen, right? And we have no control over it, but you can control what you can control. And that's focusing on yourself, your own personal strategy. There's always a strategy that works. Sometimes you get a zig when others are zagging, but you got to take what the defense is giving you. And I think that's what we're doing here at Summers Capital. We're buying boutique hotels and we're finding deals out there. And so that's what we're doing. And I think the market will shift at some point and we'll pivot our strategy. But for us right now, this is what's working for us. And that's it.
I think it's all about, I mean, it works exactly the same way on the tax side. We have a strategy for this particular client, but their situation will change. Their investment profile will change. They'll pivot. And meanwhile, the tax law will change too. And so I'm not super afraid of tax law changes because the law change just means different and new strategies, right? So there's always a way to get there to get the right result. It's just more of, having the time to think through what those are.
I love it. Well, Amanda, I appreciate you coming on and hanging out, dropping in a lot of knowledge, and we get to hang out the meetup tonight. But to conclude, where can the listeners get in touch with you?
Well, my firm is called Keystone CPA. We have a lot of great information on our website. We actually have a tax risk assessment because I think the most common question people ask me is like, how do I know if I'm overpaying in taxes? And so we finally developed a tool. It's a self-assessment for investors to go through a series of questions to see, if maybe you're overpaying in taxes. And if you are, that just means there's more opportunity. Like I said, that just means here are the areas you can do even better. But I'm also found on Instagram mostly as Amanda Han CPA. If you're looking for, if you didn't get enough from here, you want daily tax tips, that's the best place to find me.
And again, I'm going to say it one more time. If any of these strategies or the strategies that you hear on other podcasts, your CPA does not know what they are, or they're telling you that you cannot do them, you are working with the wrong CPA. It's time to pivot because they should be saving you money and not costing you money. She's Amanda Han. I'm Rich Summers. Listeners, thanks for tuning in. We'll see you in the next one. Peace.